Thanks, Marty. And can you hear me all right?
Perfect. Yeah.
Awesome. Thanks. So it's always kind of, I guess this will be the second time I've followed Alan on the HRX and art market. And it's interesting because it's a similar setup for Chisos, except the asset class is very different. Whereas he's dealing with the art world, we're dealing with individuals and individuals' future earning potential. And as it relates to building a company or pursuing a athletic career. And I'll talk a little bit about that. But my name is Will Stringer, founder, CEO of Chisos and Chisos Capital, and platform for investing in human ventures. What does that mean? Human ventures. Think of it as ambitious people pursuing a dream. Think of it as a baseball player working through the minor leagues, an entrepreneur starting a business, or an artist creating inspiring works of art. All of these individuals need capital to start or grow. Often that capital is coming from friends and family, personal bank accounts, but that's a fairly limiting factor if you're trying to start something and don't have access to those types of network capital. So how does this actually translate into an investable asset class? Income share agreements is what we use. Now, income share agreements have been used in the education space for quite a few years as an alternative to student debt. An income share agreement is kind of like revenue-based financing for an individual. It requires payback, but it requires payback based on a fixed percentage of income level. So unlike traditional credit, where I give you money, I expect payback every single month based on a fixed rate with some interest and principal. With an income share agreement, I give you money or something of value, and you pay back a fixed percentage of your income over time until you hit usually a time cap or an amount cap. So let's say 10%, you earn $0 year one while you're kind of just getting started. You pay back $0. 10% of zero is zero. Year two, you earn $100,000. You pay back $10,000 to the provider of the income share agreement. And that flexes up and down over time as your income fluctuates. So that's what an income share agreement is. And what we've done is taken that and kind of added on some features so that we can invest in people at the crux of when they're trying to start something or grow their career. Like I mentioned, the three use cases that we've identified first are one, entrepreneurs. So when you're starting a business, you often need some capital. And so what we can do at Chisos is come in and provide that early stage capital, $50,000 on this income share agreement type instrument, where you as the entrepreneur get the money and us as the investor have basically a backstop from your future earning potential as collateral. So that's generally how we work. Now, we started with our own funds. So we said, okay, this is an interesting way to invest in people. My background, I worked at a family office for a while. I also worked as an operator at a fintech. So I have a little bit of the startup background as well as the traditional investing background. So as I looked to try and invest in early stage companies or interesting ideas, the conservative family office hat or background of me said, how do I do this? How do I de-risk this? And that's where I came at it from. All right, let's invest in the person. Let's use this income share agreement instrument to provide that capital to early stage founders. And that's where we started with our fund one and our fund two. We're investing in entrepreneurs, usually day one entrepreneurs, or as a bridge for early stage entrepreneurs that need a little extra financing. And we're investing up to $50,000. So relatively small amounts of money. But often these entrepreneurs need this $50,000 to finish their engineering of a minimum viable product or start pouring some money into growth to start proving out their product market fit. So we've made 42 investments to date. We have 5 equity markups. We've collected about $150,000 of income share agreement payments. And so as a fund manager, what we're doing is working. We are currently raising our fund two. That's about a $5 million fund. We've got about $1.5 million raised. And that's our fund offering right now. And that is open. We're targeting about 20 to 25% returns on those funds. We have quarterly cash flow on those vehicles. We've made 4 distributions already to our fund 1. And so again, that avenue is working. Now, what we're looking at doing right now is kind of expanding our platform and expanding our offering and expanding the way that we mobilize capital using these income share agreements. So let me share my screen real quick and basically walk through a couple examples just so it kind of brings it home. So let's do this. So 3 examples. These are 3 examples of investments that we've made. The first is renewable. This was in Fund 1. This was an early investment that we made. This individual, basically this was early COVID. They needed about $50,000 as a bridge to keep their operations going. They had had some financing pulled out from underneath them during COVID. So we were able to come in, make an investment. We underwrote the founder as an individual. We underwrote the business. We liked the risk return profile, and we invested $50K. We got a percentage of equity in the individual's company, so in renewable. And then we also hold an income share agreement with the founder. So as an investor, we really hold both. We have this downside protection instrument that is income share agreement with the founder on an individual basis, and then we hold equity in the business. This business is still operating. They've raised over $2 million of additional capital. And so that equity stake might end up being worth something. Again, 2 ways for us to make money here: equity and income share agreement. Second logo here, True Fishing. This is a example of our downside protection. We made an investment here, about $45,000. That individual was trying to find product market fit. It was a competition fishing app, virtual fishing app you download on your phone. We liked the founder, high earner, high potential earner. We also liked the app and the business. Unfortunately, the business just didn't work out. But what happened was the individual went back into the workforce, got a sales job at exactly the income level that we thought he would. And he's now paying down the income share agreement, actually at an accelerated pace. So in that case, the business failed, equity is 0, but we're going to make about 13% on that income share agreement in about 3 years. So a pretty good return. Now, the Phillies logo here, this is an interesting one. This is a deal that we just completed a couple of weeks ago. And this is our first investment outside of the entrepreneur world. This is an individual who basically went into the MLB draft during that shortened COVID draft that happened. So didn't end up getting drafted, ended up taking a small kind of signing bonus with the Phillies organization, and has been playing in their minor league farm team for 2 years now. He came to us, we found him through an agent as we've started expanding into the athlete world. And he came to us and said, look, I need to train full-time this season because this is a make or break season for me. He's 6'6" left-handed pitcher. He needs to go to the best pitching schools, pitching camps, and spend 4 months training before spring season. And he needed $20,000 to do that, to pay rent, to pay the coaches, and to go down and live at this pitching camp. So we invested $20,000 into him. And the way that deal is structured is we took his regular income. So say he hangs up his cleats, he's got a 4-year economics degree from, I won't say where, but highly employable. And so he hangs up his cleats, he goes and works at a bank or consulting, he's going to make money. So we've segmented his other income separate from his in-sport income. And so kind of like the entrepreneur, we say, okay, we've got asymmetric upside here if you actually make the 40-man roster. If you get signed on with the Phillies or another organization, your minimum income from salary from the league is going to be about $750,000. That's the minimum. And so we've designated his in-sport income to say, look, we're going to have a 5% income share on your in-sport income. And we set the cap on that at 6x. So, we invest 20K, we can get up to 120K, which would probably happen within 2 years. On the flip side, if he doesn't end up making it into the league, he goes and gets a job, then we have a normal income share with him, 10% of his standard income, and then that'll be capped at a 2x. And we expect to get that 2x, sometime within the 4, 5, 6, 7 year time frame. So again, that would be more like a 12 to 15% return of capital. These are the types of deals that we're doing. And the reason we're able to do these deals is because there's a gap in the market. There's no structured way to actually find these deals or set these deals up until now. And so that's what we're building. We're building out basically a broader platform to be able to do these deals. Like I mentioned, we started with the asset management. We started raising our own funds to make these investments, and that's continuing on. We're raising our fund 2 right now. We're likely going to launch a fund 3, which will be an athlete fund next year, and we'll continue making those investments. We're sourcing from different areas, including sports agents on the sports world, and then we're sourcing from different entrepreneurial ecosystems in the startup world. Now, the broader opportunity that we're looking at, and it's using the same underlying technology, which helps us source, underwrite, and service these investments. The broader opportunity here is to open it up and take us out of the capital allocator seat and say, okay, anyone in the world, you want to come on, you want to build your profile on our platform. And our platform is what we're calling Inspire. You want to build your profile. You come in, you say, this is what I want to do. I want to build a company, start a YouTube channel, whatever. I need money for this. Here's my upside. I have some equity. Maybe if I make it big as a YouTuber, I have, large upside here. And here's my downside. Here is my previous income level. Here's what I was earning. You're betting on me and me not disappearing and continuing to earn income. So there's my downside. And you can take that out and you can go to your network and say, look, don't invest in this risky thing, whether it's a early stage company with no traction, no revenue, or it's some unknown YouTube channel. Invest in me as a person. And here's why you should do it. I have a track record of income. I've achieved these things. Invest in me as a person. It's a de-risked investment for you. And so there's multiple ways for that transaction to take place and multiple avenues for that capital to come in. One is the do-it-yourself, where I build my profile. I go to people I know. I ask them to invest in me. 2 is more B2B. That's, I live in Dallas and I go, and the Dallas Entrepreneurship Innovation Center has a privately managed pool of money where they're making these investments and trying to spur entrepreneurship. Or lastly, where we're headed is more of a marketplace where it's, I build my profile, I hit certain thresholds, I have certain credit ratings, et cetera. And I'm then posted out to a pool of investors that are interested in backing ambitious people. That's more of the marketplace model. And so we're building all of this right now. Like I said, we built the bones of it to run our own funds. We are in the midst of building the do-it-yourself platform, which allows you to create your own profile and go out and ask your own network for these types of investments. And that's in process. So, we are raising money for this platform right now. This is more of a seed stage investment, pretty early, higher risk. Like I said, we do have our fund 2 that is open right now. That's a lower risk, kind of more standard fund structure. Quickly on the team here. So, myself and my fund partner, Emmanuel Debucou, are the GPs in the fund. So Emmanuel's got 20 years, both as an operator working in startups, as well as a previous GP in a venture fund. So he's been in the industry quite a while. And then we're kind of supported by some different marketing, product development, and operations folks who are helping us really build out the company. So there's definitely some deep background here on building a company, as well as working and investing in entrepreneurs, as well as investing in general. Just kind of quickly showing some slides on what it actually looks like. Again, we're raising for Inspire, the platform, which is really the parent company of all of this. So if you think about what we're building, we've got Chisos up top, we've got our asset management business in one sleeve, and then we have our Inspire technologies in one sleeve, in another sleeve, which is kind of the broader technology play. So I know Marty wanted me to kind of keep it to close to 15-ish minutes. So I'll leave some time for some questions, but there is my email, and I dropped my info in the chat and would love to have conversation with anybody.
I think we have a question from the audience. Phil?
Yeah, Will, it's Phil Darovoff. Thank you very much. Very interesting presentation. Two questions. First of all, how do you, I'm familiar with the concept of lock boxes, where all the income from a pool of assets goes to somewhere that where you can collect your fee or your commissions or whatever. How do you track the income of these individuals and know that you're capturing the right amount of income? That's the first question. The second question is, it's an idea for you and also a question. I was on the board of one of the major business schools for many years, and they toyed with the idea of instead of charging tuition and instead of providing loans, taking a percentage of the students' earnings over time. And we have an issue in our society now of the affordability of colleges and how important advanced education is to earnings for an individual over their lifetime. So I'm wondering if you've thought about how this could be applied, the technology you're working on could be applied to a bigger societal issue, and have you talked to universities about this?
Great question. So the answer to the first one, we use a third-party servicer called Meritas. They're an income share agreement servicer for a number of educational institutions, both secondary education as well as different types of boot camps, whether that's vocational boot camps or coding boot camps. What they do is they have a cascading level of compliance and monitoring. So they send a monthly email that says, hey, what was your income? Please upload a W-2 or 1099 or some kind of proof. They will then go and kind of double check it and charge you based on what you reported. They also plug into a number of payroll providers, ADP, et cetera. And so if your name pops up on any kind of payroll provider, it'll alert them and say, all right, you said you weren't earning any money, but you showed up on a payroll provider. So that's two. And then lastly, which is the big one, is at the end of the year, we do an audit where we get the tax return from the individual. And so we look at the tax return and what they reported to the government. We look at what they reported to us, and then we reconcile those. So at the end of the year, if you're lying to the IRS, you have bigger problems. But we think that's the ultimate kind of stick, if you will, to monitor what that income level is. Now, the other piece for us is we try and add some kind of softer carrots. So we are trying to add value, trying to help people build their company, trying to make introductions to other investors, trying to help them with their pitch decks. And so we are trying to form a relationship, at least right now, while our numbers are fairly low, and add that human element to it. Now, that probably goes away as we scale up north of 500, 1,000, 2,000 individual investments. But that's how we're tracking income. So that's question number one. Number two is we're staying away from students for now for a number of reasons. I think number one, the big one is late last year, the CFPB came out and had basically an ordinance on one of the student ISA providers and said, if you're touching students, you fall under TILA and you fall under all these lending regulations. And by the way, you're also under the Consumer Financial Protection Bureau jurisdiction. And so, our lawyers for a number of reasons have basically said, like, look, students are one bucket. And so, you probably don't want to go mess with that bucket. And then currently the way our agreements are structured, our use of proceeds is for business oriented activities,